If you miss your corporate tax deadline in the UAE, the FTA can fine you 50,000 dirhams. And in the next 8 minutes, I'm going to show you the 5 mistakes that cause it, taken straight from real UAE SME books that I reviewed last month. Corporate tax is new. Most UAE founders haven't even filed one yet. And the truth is, neither have most accountants. I reviewed 50 UAE SME books in March. 47 had at least one of these 5 mistakes. One of them, mistake number 3, cost a Sharjah trading company 38,000 dirhams. I'm Huzaifa, an accountant from the UK and the UAE. I run Evolve Accountants. We file VAT, CT returns for SMEs across the UAE. This isn't theory. This is what I'm seeing in real books every week. Here's what we're covering. Number 1, the free zone exemption trap. Number 2, expenses that aren't actually tax deductible. Number 3, the related party rule almost no one understands. Number 4, the small business relief mistake. And number 5, the one that nobody talks about, closing balance sheets that don't reconcile. Stay till the end and I'll give you the one thing 99% of accountants are not doing for their clients in 2026. Almost every free zone founder I've spoken to thinks they're exempt from corporate tax. They aren't. Free zone companies pay 0% on what's called qualifying income. Anything else, and there's a lot of anything else, is taxed at 9%. Qualifying income, transactions with other free zone companies, income from approved manufacturing, trading, or holding activities. That's mostly it. Doesn't qualify. Selling to mainland UAE customers above the de minimis threshold. Most professional services to mainland clients. Income from intellectual property in many cases. The fix? Ask your accountant in writing for a 1-page breakdown of your qualifying versus non-qualifying income for the year. If they can't produce it in 48 hours, that's a flag. Founders deduct everything: travel, meals, the entire cost of their car, gifts to their clients. Under UAE corporate tax law, a lot of that is partially or fully non-deductible. Entertainment expenses, 50% only. Personal expenses booked through the business, 0. Fines and penalties, 0. Donations to non-approved entities, 0. When the FTA reviews your return, they will run your expenses against this list. Too much falls outside. They assess additional tax plus penalties. The fix: have your accountant produce a separate non-deductible schedule alongside your P&L every quarter. You should be able to see it. This is the one that cost the Sharjah trading company 38,000 dirhams. If your UAE business transacts with another business owned by you, your spouse, your parents, your siblings, or even a company that you control, that's a related party transaction. Under UAE CT law, those transactions must happen at arm's length. The price you would have charged a stranger. Most founders sell goods or services to their companies at cost or even below cost. The FTA can adjust these upwards, calculate tax on the adjusted amount, and apply penalties. The fix: every related party transaction needs documentation showing that it was the price was the market rate. A simple memo with 3 comparable invoices is usually enough, but this has to be done before and not after. Small business relief lets UAE businesses with revenue under 3 million dirhams elect 0% corporation tax, but only for tax periods ending on or before December 2026. The mistake: founders assume they're automatically in the relief or assumes it lasts forever. Both are wrong. You have to elect it on your corporation tax return. After 2026, it's gone unless they extend it. The fix: confirm in writing whether you've elected, what your eligibility is, and what your transition plan looks like for 2027 onwards. Don't wait. The one that no one talks about: when the FTA opens a CT review, the first thing they look at you isn't your profit and loss account. It's your balance sheet from last year compared to this year. If the closing cash doesn't match bank statements, if the VAT control account sitting on weird numbers, retained earnings figures doesn't tie back, that's a signal the books haven't been properly closed. A messy balance sheet doesn't just create one tax problem, it creates a suspicion of all tax problems. The fix: ask your accountant to produce a 1-page balance sheet reconciliation every quarter. Bank reconciled, VAT control account reconciled, retained earnings tied back. Quick story before we wrap up. Last month I onboarded a Dubai e-commerce founder who'd been with the same accountant for 3 years. Books look clean on the surface. We ran them through these 5 checks, found 4 of the 5 problems. Her CT exposure went from what her old accountant told her, about 12,000 dirhams, to a real number of 46,000 dirhams. She had no idea. Her whole accountant had no idea. That's why I'm making this video. 3 things you can do right now. 1. Go to evolveaccountants.ae. CT checklist and download our free CT readiness checklist. Run your books through it this week. Number 2, ask your current accountant for the 5 reports I mentioned: the qualifying income breakdown, the non-deductible schedule, the related party documentation, small business relief confirmation, and the balance sheet reconciliation. 3, if you can't get those in 48 hours, message me on WhatsApp. The number's in the description. We'll do a free books review. And as promised, the one thing 99% of UAE accountants aren't doing in 2026, they're not sending their clients a plain English monthly summary. Just numbers, no story. If you don't understand your books, you cannot catch these mistakes. In the next episode, I'm going to file a real VAT return live on this channel, including the 3 things that most accountants get wrong on the portal. Subscribe so you don't miss out. Stay compliant. I'll see you in the next one.